What if I told you there's a secret fear gauge that the pros watch, but most retail investors ignore? A single number that spiked before the 2008 crash, the COVID collapse, and even during recent India-Pakistan tensions in 2025, warning those who knew where to look. It's called the VIX, and in the next few minutes, I'll show you how to read it, what it means for your money, and how it can help you make better investing decisions, especially when fear grips the market. If you're serious about understanding the market, not just riding it, hit subscribe because this is the kind of stuff they don't teach in school. March 2020, the world stopped, stocks crashed, investors panicked. But there was one indicator that screamed a warning before the chaos unfolded. It's called the VIX, and if you know how to read it, it can be your edge when others lose theirs. The VIX, short for Volatility Index, is often called the fear gauge of the market. But it doesn't predict prices, it measures emotions. Specifically how scared or calm investors are over the next 30 days, based on S&P 500 options. Think of it like a weather forecast for the stock market's mood. Sunny skies, low VIX. Incoming storm, VIX spikes. Here's how to read it. Below 15, investors are chill. Between 15 and 25, some nerves. Above 30, full-blown panic mode. In 2020, the VIX Index shot up to 85, its highest in history. And that's when fortunes were made, by those who stayed calm. Let's go back to March 2020. As the pandemic hit, the VIX soared from 15 to 85 in just a few days. The market crashed over 30%, but here's the twist. While retail investors rushed to sell, savvy investors like Warren Buffett waited. As fear peaked, they quietly began to buy. By the time VIX came down, the market had already started recovering. That's the power of using VIX, not to predict, but to prepare. Flashback to 2008, the global financial crisis. Banks were collapsing, VIX hit 80, doom was everywhere. But if you had bought quality stocks in early 2009 when the VIX was still high, you'd have tripled your money over the next few years. The rule? When VIX is high, the market may be near maximum fear. And fear, as Buffett says, is when you should be greedy. Fast forward to April 2025. A tragic attack in Pahalgam, Kashmir claimed the lives of 26 tourists, escalating tensions between India and Pakistan. The market reacted swiftly. India's VIX Index spiked above 20, signaling heightened fear among investors. However, with the announcement of a ceasefire on May 10, 2025, brokered by international diplomacy, the VIX Index began to stabilize, reflecting a return to cautious optimism. So how can you use the VIX? If you're investing regularly, like through systematic investment plans, high VIX is your friend. Prices may be down, but you're buying more units. If you're a trader, low VIX means complacency. Watch out, it could signal an upcoming spike in volatility. And if you're a long-term investor, use VIX to tune your emotions. When fear is high, stay calm. When everyone's euphoric, be cautious. Now, here's what most beginners miss. When the VIX is extremely low, say under 12, it doesn't mean all is well. In early 2018, VIX was at record lows. Markets were euphoric. Then came a sudden 10% correction. The VIX spiked, and many were caught off guard. So yes, low VIX can sometimes be just as dangerous as a high one. It's all about balance. The VIX doesn't predict the future, but it gives you a glimpse into the market's mind. It shows you the collective emotion, fear or confidence. And when you can read emotions objectively, you make smarter decisions. So next time markets get wild, check the VIX, and remember, fear creates opportunity. The VIX is not a crystal ball, it's a mirror. It reflects collective fear, not your personal truth. In investing, as in life, storms will come, but peace comes from knowing when to act and when to simply observe. Use the VIX not to predict the market, but to understand its mind. And when others are swept away by emotion, you stay grounded. If that perspective helps you breathe a little easier as an investor, subscribe, because here we don't just chase returns, we build wisdom.